Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager with Canaccord Genuity Wealth Management and partner at LLC Private Wealth. Thanks for joining us again this week for our tactical portfolio weekly updates. Obviously, we haven't had a couple of weeks of updates given the holidays and out west here, obviously some unusual weather, but we're back to normal. So do join us every Tuesday. We're going to give you an update on what's going on in the markets, what's going on in the portfolios, and where we see things kind of headed for the week. And today we're going to do a little bit of looking ahead for the month, or sorry, for the year, just because we're into the new year and we haven't done an update in a couple of weeks since late December. So with that, let's start things off by, as always, keep in mind everything we cover in these videos or anything we put out is for educational purposes only. Always reach out to us. Go to mikeonmoney.com. You can book an appointment directly there with me. You can see our other videos. You can email or even call. Happy to talk to you. Go through your particular situation. Make sure what some of the strategies we're covering off here fit in your plan or in your strategies, or do your own due diligence. But make sure you check things out because you want to make sure things fit into your portfolio. All right, so with that, we'll jump into things. Obviously, December kind of finished off on a negative note. We did not get the Christmas rally, the Santa rally that we sometimes see in the markets. Most of that negativity, though, I think was really centered around tax loss selling, as we did send out to everybody on our list some tax tips in late 2022. And one of them was to take advantage of those kind of capital losses in 2022, because you can file back 3 years your tax return. So, 2021 was some big capital gain years. And if you had some tax loss selling, you could claim those losses, refile for 2021 and get some of that tax money back, or even, lock in those losses and use them for future tax years and future capital gains. So there was quite a bit of that in December. So that pretty much was driving what was going on in the markets, and of course, with lower volumes in December, which is only natural, that led to some negativity in the markets. The markets overall ended pretty rough for the year. I think the last number I saw for the S&P 500 was just around minus 19%. And NASDAQ was worse, over 20, and the TSX kind of in those ranges as well. So, all in all, think about last year is about a minus 20 year for the market. So as far as the tactical portfolios go, we were really happy. They held in pretty strong throughout the year. Actually, we're almost moving to a positive note going into December, pulled back a little bit then December, but overall did quite well, hung in very strong. We still have a strong cash position in the portfolio that is allowing us to take advantage of these dips, take advantage of some of this lower pricing. And also that cash position is now earning some great dollars thanks to the interest rate hikes we saw last year. If we looked at the beginning of 2022, the cash in the portfolio was earning around 1%, maybe just above that. And we're getting almost 5%, about 4.75%, just shy of 4.75% on the cash positions right now in the portfolio. So that's doing, at least working, paying some strong interest. And we'll cover off some more positions in there where we're seeing, really great dividend or cash flow out of the companies, even if we're not seeing the capital upticks that we'd like in the markets, that's due to the weakness that's going on out there. So let's talk a little bit about where we are and where we're headed. January did start off with a pretty good start. The market's being a bit more bullish. That tax loss selling kind of behind us. And in our portfolios, we did a lot of tax loss selling as well. So, I don't want to blame the general trend. That, was the wise thing to do. But January, we've seen things start off pretty strong. A little pause this morning on Tuesday in that strong start to the markets. Nothing negative or not overly negative today. Really, what we've seen is a big surprise in the job numbers. So the new job creation numbers came out for both Canada and the US, and they were stronger than expected, meaning, the economy hasn't slowed down as much as maybe the central banks want them to, or what they were trying to do with those interest rate hikes. The unemployment numbers fell for both countries. I don't think that's a huge concern, but the market's certainly taking a little bit of pause to analyze those numbers and kind of see what that means as far as more interest rates going forward. We did see a little bit more hawkish language out of the U.S. central banks. Canada had indicated in December that they were going to ease more on those interest rate hikes, maybe even in pause. So we'll have to see how they come out and look at those job numbers and whether they do more hikes again. Given they were a bit stronger, but I think it was more of a blip. I think we're doing a little bit of catch up on those higher numbers at the end for the end of the year, and we're probably going to go back to the trends that the central banks were expecting, which is again move into a higher unemployment rate, not crazy high, but definitely higher than we are right now. And so again, get back to the slowing or even pausing the interest rate hikes moving forward. So, and that leads into kind of the recession story. So, are we in a recession? We've talked about it in the past. Hard to tell until you're 9 months in, and even that is not always a straight line. Sometimes we have these little pauses, and that can stall the idea of a recession, but that doesn't mean the economy is not slowing down dramatically. And that's really what we're watching for, is what the economy is doing, and whether we can orchestrate that soft landing where we just touch a recession, or actually never dip into an official recession, but still slow the economy down and get things turned around. We are still seeing some positive growth in the overall economic picture. Still a lot of overhangs, and on a lot of them, you got to look outside the economics these days, because one of the big things, especially when we're talking around the inflation, where we've seen the numbers turn around with inflation on most goods. If you look at consumer goods, if you look at most indexes, even fuel, all those things out there have come off their highs. We've seen the inflationary numbers dropping, but the one area that really hasn't come down too much, or in some cases not at all, is food prices. And obviously that's a big impact on people's spending, and it hits them really hard at home, and it's a big number also in the inflationary index. But we have to look outside the economics on that. Obviously, the war was a big impact on that in 2022, but also weather, right? We've seen prolonged droughts. We're seeing extreme storms. We've seen that, last year here in BC, of course, we were hit with that massive rainstorm that took out the highways and a lot of our farmlands. Now, California this week is being hit with that, what do they call it? The atmospheric bomb. That is affecting food prices, especially in North America, but around the world. So that's another aspect that we don't really always look at in the economic picture. But when we talk about agricultural costs, obviously that's a big impact that we have to keep a really close eye on, and how that's going to play out in inflation for 2023. So what do we need to turn things around? Obviously, we need to have inflation under control. We need to see the central banks pause, or at least slow their outlook on interest rate hikes, and hopefully, as I've been talking about, hopefully in 2023 actually see maybe some small cuts to those rate hikes that we saw in 2022. We need to start seeing that. Haven't really seen that come around yet. So we do expect, as predicted last year, we talked about this first quarter still being bumpy, but that doesn't mean that there's not opportunities out there. So what are we seeing in this kind of bumpiness and this volatility? Well, we're really digging into the sectors and seeing where the opportunities are there. Obviously, tech was hit the hardest in 2022. A lot of people are really focusing on that to turn around. And I agree, it is a great sector where we're going to see probably some good growth once we get through things. I still think it's too early. And if you're looking for an indication of that, is the layoffs in the tech sector have just started. We're seeing more and more every day. Google, who infamously does not like to do too many layoffs, doing some big numbers this week, or announcing big numbers this week, and other companies, following suit. So we're still seeing a lot of layoffs in that arena. We haven't seen a ton of demand kind of picked up around those services, and still a lot of concerns. So I still think it's early on tech, but it is volatile. If you're, in the portfolios, keep an eye for us to do some more dynamic trading, so more in, take advantage of a run up, ease off again, and then maybe go back in again to some of those names, because we are going to see that volatility in technology as it tries to find stable ground. Oil's been a bit more volatile than we expected for the end of the year. It is picking up steam again going into this year. Again, the theme there is pretty much the what if there is around Russia and where they're going to backdoor their supply into the world and at what price they're going to put it in at. So keeping a close eye on that. Still see some strength in demand versus supply there. But we don't see that past this year. I do see things kind of tapering off. I won't dive too much into that. I think that deserves its own video, because we have to dive into global demand around oil and gas or fossil fuels in general, and this push towards more green technology or renewable technologies. And of course, as we mentioned before, that takes time to get up and running and get that infrastructure in place. So we have now had a couple of years since countries have started focusing on that. So we're getting closer and closer to that transition, or again, not complete transition, but where it's going to start to weigh a little bit more impact on the demand on fossil fuels. So I won't dive into that today, just for interest of time. But if you're interested, as I said, give me a call. Go to mikeandmoney.com, follow our videos. I'll try to do a one-off just on that topic alone. The other sectors we're seeing some weaknesses are obviously consumer discretionaries and even some consumer staples, as people become a bit more frugal on their spending. As I mentioned, the cost of food increasing is impacting a lot of families around the world, especially here in North America. So that spending is starting to decrease a little bit. Consumer discretionary, so those are kind of the wish list items, kind of the high ticket items. We're seeing a lot of people backing off on those. So be careful in those sectors. They're going to continue to see pressures this year. The big ticket items, obviously the cost of financing is higher, so people are less likely to go after those. And then even on the consumer staple side of things, keep in mind people are cutting back or saving. If you look in the portfolio, we still have some grocery positions there with Alman Couche-Tard, but we also have dollar store. So we're still looking at people being more frugal, looking for better deals, even on those fronts. As far as positions in the portfolios, we really like how the portfolios is positioned, but I'll highlight a few. I know there's been a lot of questions around the fixed income side of things last year. The bonds, we have a couple of PIMCO positions, PIMCO being one of the largest institutional traders in the world around fixed income. Those portfolios are still incredibly high quality. Yes, they're down when we look at the cost base compared to where they're trading right now in the portfolios. But that's mostly because the lack of volume in the bond market. Pretty much the volume left in fears of the bond market. But we're still confident they're very high quality, they're very short term. There's nothing, really long term in those portfolios. Talk to the managers on a regular basis. They are paying us over 9.25% while we hold those. So, assuming that those portfolios snap back to their face value, which that's what bonds do. They're kind of like a GIC, only they do trade. So you do see that volatility of the trading market. But as we hold those positions, and then they go closer to maturity, they're going to snap back closer to their face or their intrinsic values. But while we're waiting, we are collecting almost that 9.25% on both those positions. So don't worry about those in the portfolios. I still really love them. They're going to pay off, really well for us in the near, hopefully, within a few months. We see that shore up as I mentioned, the softening of the central bank's interest rate movements. We'll start to see that market pick up again. But in the meantime, we are collecting that interest rate. So still really love those. In the portfolios, we're seeing a lot of activities, corporations, especially on the restructuring front. You probably saw your Brookfield position in the portfolio spin off last month, end of December. And we had Brookfield Asset Management. Brookfield spun off the asset management part of the company, actually. So they spun off some shares, new shares, also called Brookfield Asset Management, but they were just the asset management side of things. And also we kept in the portfolio the Brookfield Corp, so the parent company that owns Brookfield Asset Management. and a more diverse group of companies, which was the original position we held. They just spun out the asset management side of it. So we saw that in the portfolios was positive. We still like Brookfield, still looking good. We're also probably going to see that. Well, we are going to see that in the Johnson & Johnson position this year. So Johnson & Johnson last year announced that they were going to spin off the pharmaceutical from the kind of the health product line in 2023. So they're just working on that restructuring. They're doing filing this month. So we'll get more information on what that's going to look like. But basically, you're going to end up with 2 Johnson & Johnson positions, or whatever they're going to name those. One being the pharmaceutical, one being kind of the consumer goods. And we'll see what those, as we get more details on that, see how we're going to manage that position, but it should be positive in the portfolio, so we continue to like it. I want to follow up a little bit on the Algonquin position that we had last year in the portfolio. So Algonquin was still a really good company that we really liked in the portfolio. Obviously took a bit of a hit last year on the stock price. We did sell out of it because we felt there's more shoes to drop. We haven't moved back into it yet. Still watching it closely. It's a power company out of Ontario. Mostly their business is renewable and unregulated. So, you know, a kind of a great business to be in. It's all in the right parts of the market as far as tailwinds go and outlooks go. They mostly got hit a bit on they did an acquisition, or they were working towards an acquisition last year to buy up a competitor in the United States. And that deal, obviously with the markets going down, was going to cost them a little bit more than they originally thought, you know, given that valuations went down, but also the carrying costs or the financing cost of that went up with interest rates. So markets didn't like that. That's mainly what we saw the stock price getting hit. They still want to move forward. As far as we know, there is a call coming up with management where I'll get more details later this week. But still looking to move forward on that acquisition as far as last reported. The regulators did block that in the United States, so they're looking at what they need to do to satisfy the regulators' requirements in order to follow through with that acquisition. Which should be very accretive for the company. We did like it last year. Obviously got impacted, you know, by the end of the year before the deal could close. But overall, we liked it for the firm. But given kind of the current conditions, this might be an opportunity for them to opt out. If they do go through, it looks like they'll have to sell one of their other divisions. And we really need to get some more details on that, because the division that most likely that they would sell would actually move them away from, you know, being more renewable, and also put them a little bit more toward the regulated side of things. So that might impact their finances. So we're keeping a really close eye on that. I still think, depending on what management's paths are going to go forward, we might go back to that position. And obviously they are going to cut their dividend from where it is today, about half where it is today. That's a bit priced in, so we're not concerned about that, but we are waiting for that to be an official announcement, so we know exactly where things are headed on that front. So that's pretty much kind of what's going on in the portfolio. Everything else is chugging along really well. We do have those cash positions that we're looking to take advantage of in this kind of first quarter of volatility. Our plan is still, assuming nothing changes, get that cash to work here at these lower levels in the first quarter and take advantage of some ramp up. As far as our weekly updates, as mentioned, we are going back to a weekly format, so you can catch us on here. If you want to catch us on a replay, of course, we always send out the links for the replay, and also on our podcast where you can listen to it. And we also are going to start up again this year, follow up from last year, continue with the Mike on Money topics. And you might have also seen that we now also have my partner Harold Leishman put out new videos on venture markets and updates on different opportunities in that, with one recently on some changes to the venture financing, which definitely benefits investors who are looking at that arena where you don't get locked up or you don't have the mandatory 4-month hold anymore under certain conditions. So I recommend you go check those out. It also will be on the same channel where you can find all those at mygodmoney.com, or on our website. You'll also find Harold's videos on there as well. So with that, everyone, take care. Remember to reach out with any of your comments, questions, and ideas that you might have for us to cover on here. We always welcome those. And with that, I wish you a good week and a happy new year and a great start to 2023. Thanks, everyone. Take care.